Hey guys, my name is Max Convexity. Thanks for tuning into my channel today. I have what I hope will be a good one for you. It's called True Yield 2025, the next episode. Growth is good, income is necessary. All right, well, how can I compare 120% paying high yield dividend stock with, say, a 12% payer? I can't just divide by 10 or multiply by 10. There has to be a better way. I've been looking for the perfect metric for comparing high yield ETFs to each other. I really like my True Yield series. I said that Defiance would have a true yield of about 8 to 12%, and I was right. The true yield was the amount of total return left over after everything was said and done, after you subtract all the bad stuff the critics were saying about it. How much would you actually have left at the end of the year? I think it really had 13%. I think 8 to 12 was a pretty good guess. I made that guess about nine months ago. My new metric, I'm trying to do the same thing, but in a more sophisticated manner. So how can I compare an ETF that pays, something like Alti, where it pays 80 or 90%, with something like JEPQ that pays 12%? So everyone knows, of course, JEPQ, the 12% is less risky, and that's why people like to invest in them. That's what we'd expect. There has to be an apples to apples way to compare them. Just for a little background on me, in case you haven't heard me say this before, I believe there are no bad high yield ETFs, or at least the ones I talk about aren't really bad. There are ones that have different bad qualities and different good qualities. Some of these high yield ETFs have gigantic dividends and tons of NAV depletion. Then they have some of these other high yield ETFs that have less of a dividend and a little bit less NAV depletion. Depending on your needs, one or both of them might work, or neither of them. High yield ETFs are just like dogs in a sense. It's how you train them and how you use them. We're just like tools. So I've seen people on margin go all in with these, and a lot of them have been doing well. And I support them 100%. It's just not for me to really begin for me to peel back the layers of the onions and kind of see what I wanted to test. I first needed to make a reasonable high yield ETF use case. And I was just going to say the all in on margin to me is not reasonable, but I do wish those people the best. I've seen many people own these high yield ETFs successfully by allocating the high yield ETFs as a smaller part in a bigger portfolio. These high yielders should complement our holdings. I mean, ideally. All right, so we're going to introduce something today called the Dennis Rodman factor. So who was Dennis Rodman? Now, Dennis Rodman was a star in the NBA in the 90s, and he was not good on offense. He averaged about 7 points a game for the career. Where peers, people with as big of a name as him, his peers, Barkley, Jordan, would average 25, 30 and more points a game. So he was like 1/5 as productive on the offensive side of the board. But he was a defensive monster. He had bad offensive stats, but people that knew basketball loved him. He made everyone that he was on the floor with better. Even though he wasn't a big scorer, the other four guys that he played with were statistically more likely to score with him on the floor, getting extra rebounds and playing defense. Rodman was the original disruptor. Can an ETF be like Rodman? Which ETF allocations are the most additive to a retirement portfolio is the question I wanted to ask myself. Rodman made his team better. Which ETF makes their team better? What does QQQY do to its team? What about JEPQ? What about GPIQ? Which ones? I want to see which one's more like Rodman and which one's more like Barkley. Okay, so these are what we're testing today: JEPQ, QQQY, and GPIQ. You can see the Goldman Fund has about almost 400 million under management, but you can see the JP Morgan Fund has 20 billion. Anyway, QQQY is down there with right around 163 under management. Now I've tested this. GPIQ is the youngest. The inception date is October 24th, 2023. The start of this test that I'm running on these three starts November 1st of 2023. So it is a 13-month test. Okay, so here's what I did. I normalized by starting with the results, and there's ETFs that do this also, but target funds do this. They figure out how much they want to earn, and they make the ETF earn that. Well, I'm doing something similar. I've figured out how much I need to make in retirement, and I'm allocating the ETF in such a manner to make that much. I started with the goal. So I'm going to say that since the goal is 5% or 50,000 on $1 million, where it'd be 100,000 on 2 million. I believe these ETFs, I believe this is kind of a slightly elevated retirement. Your typical, off the shelf retirement revolves around 4% withdrawal rates. Okay, so this would be based on a 5%, which may not sound like that much, but it adds an extra 20% to your retirement income. The idea is we'll use as much of the high yield ETF as we need to reach the $50,000 goal, and then we aren't going to use any more. Then the rest would be in growth, of course, right? The idea with paying yourself $50,000 is that it's a reasonable rate to expect, on that amount of money in retirement. It's not something that's so high it's unreasonable. It's reasonable, but at the same time, it's only 50,000. It's only 5%. So that leaves 95% of your assets in growth. If this is our baseline allocation yield goal, we can easily compare different ETFs with each other and different ETFs with just buying and holding the index. So today we're gonna test QQQY, JEPQ, Goldman Sachs, GPIQ, and just the Qs by themselves. Now let's look at the conventional metrics. Now the conventional metrics right there, you have that's Defiance's NAV return. Doesn't look great. That looks about like, Rodman's. That's about like looking at Rodman's scoring line and say, man, this guy's terrible. There's another side to the story, but it's sure not apparent by looking at that graph. And really, it's not apparent by looking at this graph. Defiance looks sketch here as well, leaving a lot of total return on the table. So let's see what gives. And I hear all day long how much people dislike Defiance. And a lot of people just can't get past those past two slides. There's an expense to knowing the truth. This is why college isn't free. This is why good colleges are more expensive. This is why better books cost money. This is why you have to subscribe to better databases and better services. The truth is hard to figure out and comes with an expense. If you want to know a lie, it's easy. Just turn on the mainstream news, read Wikipedia, turn on CNBC. And CNBC hates these high yield ETFs, of course, especially Defiance. They told Sylvia these were picking up pennies in front of a steamroller, which is not a compliment. That was not a compliment from CNBC. I don't think they're right. I think they're wrong. Oftentimes, the truth is nuanced and boring and involved and takes some extra time to comprehend. Really, to compare these ETFs, we normalize the growth, and then I try to extract what's left over. That's what we want, is what's left over. What's left over is, to me, is the whole thing. That's the prize. That's the pot of gold at the end of the rainbow, is how much money I can have in growth assets. The reward for wading through all this information to get to the truth is that actually Defiance ranked higher on this Rodman metric, believe it or not. All right. This shouldn't be a surprise to anyone who's been watching my channel. What this means in real life is the Defiance was able to allocate a portion and pay a living wage, $50,000, but at the same time, it contributed to an allocation, a portfolio that did 96% as well as just strict buy and hold. Okay, that's pretty good. This is the money ballification. This is money ballification at work, pretty much. JP Morgan was only a 92, but that's still pretty good. Goldman Sachs got a little bit less. Let's kind of look into it and see what happened here. This is from Portfolio Visualizer. This isn't my back tester or anything. I wanted to use some professional software and see if it was saying the same stuff that the retirement simulator's been telling us. And okay, here's where I started with it. I made an allocate. Well, actually, let's do it this way. Here's if you have 100% just in those three funds, 100% in QQQY, 100% in JEPQ, and 100% of your retirement in Goldman Sachs. Okay, well, here's what happens. The 100% in Defiance was down 39.2% on the year. The JP Morgan was up 18, Goldman Sachs was up 20. Great job, guys. The catch is there's the NAV return. That's not great. The catch is right here, portfolio income. All right, so if you look here on this is on this is just on $1 million portfolio. Wow, that blew me away. So on $1 million portfolio, this Defiance generated $915,000. That's a lot of money. Okay. Now, JEPQ and GIPQ generated about a fifth of that. Okay. We don't need 900,000. And we know if we take the whole 900,000, it comes with consequences. At the same time, these guys down here, no one's going to put 100% of your money in JEPQ. They aren't going to put $2 million in that to get an income of 200,000. Most people that I see that invest these use a portion. They allocate these as a portion, kind of like a fixed income portion of your portfolio. You have a covered call portion of the portfolio. So what I did to normalize it is I adjusted both totals to be like this, to be real world, what somebody in the real world could likely do with $1 million. $50,000 or 5% is a perfectly reasonable goal in retirement, I think. Now we tested 2 months into the last year and then all of this year. That's why it has, all the funds earned about 10,000 last year, but then exactly 50 this year. I just fixed the percentages till they earn the same amount of money. So I left everything else in growth. So what I've done is I've extracted what we need. Remember, growth is good, but income is necessary. I subtracted what is necessary, and then what's left over is what's left over. So in the case of QQQY, it only took a 6% allocation. So it left 94% in the use. I thought this was interesting as well, right? The down periods, QQQY was down 4.3, which is more than JEPQ and more than GPIQ, but it was down slightly less than buy and hold, for what that's worth. Here's the bottom line. $1 million, starting with $1 million, did the QQQY strategy. So what was that? 6% QQQY and the rest in the Qs. You end up with about 1.37. Second place was JEPQ with 1.36. Third place was GPIQ with 1.35. Buy and hold beat all of them. Buy and hold was the best. QQQY returned 29.35. Buy and hold returned 30.69. Now you can see in annual returns, last year, the Defiance portfolio had higher returns than the other ones. This year, Defiance was had higher returns than Goldman, lower returns than JEPQ and buy and hold. But for the 3 years, they had higher returns than anyone except buy and hold. I'm going to share this sheet, this PDF with you guys in case you guys want to look at this and look into more detail, but there's some pretty interesting stuff in here as far as the risk and reward metrics and the way it even breaks down the expense ratio. It breaks that all down. Anyway, I think this is really interesting. The too long don't read is, hang on. The too long don't read is Defiance did all right. Maybe better than some people expected. I kind of subscribe to the belief, and that's kind of how I built this test. I built this test for two reasons. A reader gave me an idea, a subscriber wrote an email, and he gave me an idea with normalizing the yield. Now, he didn't tell me to test it on Defiance or anything, but he gave me the idea just as far as allocating a high yield portfolio. So, but then I took it a step further, and I wanted to see if allocating that way with Defiance, where you actually need less of it to get the same result, could actually put you in a little better situation. I subscribe to the modern portfolio theory, the belief that folks don't like risk. People avoid risk. Other things being equal, people will allocate around risk or in accordance with the risk. No one's going to go all in on these. No reasonable person. It's going to be some smaller percentage. So I just didn't think it was fair to test them all in. Once you normalize for yield, Defiance was the best in this test over the past 13 months. That's pretty impressive. I'm not surprised. This is what I've been, saying the entire time, but this illustrates the strength of Defiance. So QQQY caught 95.52% of the Q's upside. JEPQ caught about 91%, and GPIQ caught 88% during the course of this test. So Defiance gets a Rodman rating of 96. So that means I can compare Defiance with the next fund I find. There could be a fund that they introduce tomorrow or whatever. You could pick another fund, and we could look at a year's worth of stats and put it through the same test Defiance is and see how it holds up. Well, so we'll start giving these funds the Rodman test occasionally, just kind of so I can compare them to each other. I think it's interesting. I hope you guys do. I've always preferred Defiance because I like more of everything, and they have more yield than their peers. The Rodman rating illustrates the more yield, and that's actually what makes them do better, because since they do have more yield and since they're more efficient at gathering yield, or other things being equal, they can get the same amount of yield for a smaller allocation, leaving a higher allocation left over for just growth assets, the Qs. So what that gives you in a year where you have a bullish year and you're allocating extra to the Qs, that gives you a big win. Now, had this been a bearish year, it's not magic. There's nothing's magic. We'd done the same strategy, and had it been a bearish year, the Defiance fund that only had to put 6% in QQQY and then could put the rest in growth. Well, if the growth isn't growing and you have extra in growth, it would actually be the worst performing fund. So all I've done is create a good performing bull market fund. A lot of these are good, or these funds are pretty much based on bull markets for sure. A lot of these are going to do one heck of a lot better in bull markets. But I thought it was interesting, even after you factor in the expense ratio, that's in here. Even after you factor out all the NAV depletion, that's in here. Even if you understand about erosion and depletion, even if you understand how QQQY's underline works, they do have an underline. It's based on the NASDAQ. Even if you understand all that, it's nice to see in black and white. It was nice for me to see that it has outperformed some of the bigger names in an apples to apples comparison. So this is just one test, though. It just outperformed on this test. There's other tests when it's underperformed. But I did like how these were real world results and not something that was projected. And of course, this isn't what's going to happen next year, of course. Now, but what I was really trying to figure out is the give up. 94 was the give up. The Rodman rating of 94, well, 100 would be perfect. It means you only, or it's 96. It means you only gave up 4. Okay. Still, there's no such thing as free money, and we know that. This is just a way to measure what you're giving up. In real life, I expect to pay a fee in return for financial service, even if it's hidden, or oftentimes it is hidden. The service the high yield ETFs perform is they turn equity in the stock market into income that you can spend. If I didn't require spendable income, of course, I would just keep my money in growth. But I require some level of spendable income. I want to make an apples to apples comparison on a portfolio level. So I did my best to moneyballify the metric. I hope you guys liked it. So what does everyone miss about these things? Here's what everyone misses, and I'll show it to you one more time. Everyone wants to compare them like this. 100% to 100%. Yeah, and these are not good standalone funds. Okay? I mean, not at all. What do I always say? If somebody stuck a gun to my head and made me put all my money in any one of these, it'd be JEPQ. And sure enough, I may need to switch that answer from now on to GPIQ. It looks like it has a little better total return. You know? Also, and it comes down to everything else. What's the first thing I always say about these is only if you need the money. And you can see, look at the disparity in income production between these two ETFs. You have 5 times as much income over here. You know, that's so. And when it does come time to need income, the only good news about this fund is you can use 5 times as small of an amount as you have to with some of the bigger funds to get the same income result. Okay, we can figure out what the income result is with math. And what I was trying to figure out is once we subtract the income out of it and equalize it, make it 0, what's left? And that's where I came up with the 96, 92 Rodman ratings. But I will share these. This has all kinds of other in-depth information that you guys might like. I'll share both of these PDFs. I'll share the one that backtests 100% on all of them, so you can see how bad Defiance does. Then I'll share the one where it's properly allocated. In real life, no one sticks a gun to your head and makes you put all your money in any one fund. That's why I thought it would be interesting to show how these work as a mix with your growth portfolio. The idea is you don't want, the growth is great, but income is necessary, but you don't want to mess up your growth by getting income. Oh, and I also wanted to say a brand new day today, I guess. I'm going to turn on memberships. It's going to be $4.99. Please consider joining the Max Fam. I guess that's what I'll call it. You'll get, you're going to get access to some private stuff, especially with regards to the Max Factor numbers. I'm going to have a live stream today at 3, and there'll be more information on that live stream. But please consider joining the Max Fam, and I'd really appreciate it. But if you can't, that's fine. Also, I'm still here for you guys. There's really not going to be any difference. I mean, obviously, I'm going to give Max Fam members preference, but right now I don't have that many of you. I can answer all questions that I have. Come to the Discord. Discord's free. Ask me questions as long as you want, to your heart's content. I love to talk about this kind of stuff. All right, guys. I appreciate you all. You have a great day.